Good evening, everyone. Speakers of the day, Mr. Bhadresh Doshi and Ms. Akshata Kapadia. Treasurer Manish Sampath, Chairman of the Accounting and Auditing Committee, Mr. Himanshu Krishnadwala, Chairman of the Corporate and Allied Laws Committee, Mr. Kanu Choksi. Past Presidents of the Society who are present here, seniors, ladies and gentlemen. On behalf of the Bombay Chartered Accountants Society, I welcome you all to this lecture meeting on filing of income tax return for AY 1718. But before we start the lecture meeting, I've got a very pleasant task to perform and also a rare feat. Today, we are releasing not one, but two publications. In fact, 6 publications, and I will tell you how. One of the publication is by the Accounting and Auditing Committee, titled FAQ on Accounting Standards, and the other, a set of 5 publications under a monograph series by the Corporate and Allied Laws Committee. The FAQs on accounting standard is authored by 16 vastly experienced chartered accountants, and it is the Society's privilege that the publication is released under the auspices of the Shailesh Kapadia Memorial Publication Fund. I also acknowledge the presence of Shailesh Bhai's family members who are present here and their continued support to the Society. Shailesh Bhai was a past president. Shailesh Bhai was a past president of the Society, and in his short but dynamic professional career, spanning over 14 years, Shailesh Bhai held important positions in various professional and public institutions. This will be, I think, the 14th or 15th publication under the fund. So once again, I will request you all to acknowledge the contribution by Shailesh Bhai family. As far as the monograph series is concerned, the booklets are very handy and also important and relevant. The topics selected for the monograph series are freedom and restrictions on speech and expression in social media, corporate social responsibility, prohibition of insider trading, competition law, and India's law on prevention of sexual harassment at workplace. I also acknowledge the presence of few of the authors of the publication and the reviewers who, despite their busy schedule, could be present here for the occasion. May I now request Himanshu Bhai to share a few words about the publication.
Good evening to all of you. The publication is FAQs on accounting standards, and at BCA we thought that we need a book on the accounting standards which are applicable to non-Ind AS companies. Everyone hears about Ind AS companies, Ind AS accounting standards, and everyone tries to follow those standards. But what at BCA we realized is that 90% of the members still deal with non-Ind AS companies, and they are doing the audit of non-Ind AS companies. And for them, there is hardly any literature available as to what are the simple issues which they can face on the day-to-day conduct of the audit as such. So with that in mind, somewhere in January 2017, in the city of Kanpur, where BCA was having a joint program with some other organization, we thought about this particular publication, and it covers for each of the 27 standards which are applicable to non-Ind AS companies in a question answer format, and also covering some of the observations of the FRRB on the selected standards which are there as such. We believe this would be a very handy publication for all chartered accountants while doing the audit, and also very handy for accountants when they are trying to prepare their financial statements as such. And it is obviously a very proud moment for BCA that this book, which is going to be useful for a long time to come, is being published under the auspices of Shailesh Kapadia Memorial Fund. May I request the whole family to come up and release the book. receive a copy of that. There are 16 authors who wrote the FAQs. All of them could not be present, but we have got almost 7 or 8 people who are there. And I'll request Chetan to hand over a copy. Nalin Bhai, who reviewed the entire book. Abhay. This book will be immediately available for sale from tomorrow.
This is the 5th book by the Accounting and Auditing Committee in this year, and one more publication is expected maybe in the next month. So they have done a fantastic job. The other book that I referred to is a monograph series, and I will request Kanubhai to just share a few words.
Very good evening to everybody. President, sir, dignitaries on the dais, past presidents present over here, seniors, professional colleagues, and would-be chartered accountants in due course. Welcome to this evening, and I think President has already referred to the subjects in detail. My memory goes back to the activities that the society is always carrying out, or for the benefits, the 3 categories: the members at large, the students at large, and the public at large. The publications which are published by society are of so use that today also, particularly I am referring to the students present over here, there is a publication called as the Qualifications in Auditors Report, published by the Accounting and Auditing Committee. If you make an attempt to read this publication, which is almost 14 to 15 years old, today also if you compare with the commentaries given by the ICI or any other notes given by there, the publication stands out to be at the top for any query, maybe the students have or the members have at large. That is the kind of the quality that the society publications are. The Corporate and Allied Laws Committee decided to have a series of monographs. Of course, it's a little old story, but nevertheless, I am sure the members present over here and the students present here would definitely find it of interest. I am aware that at the students' part, they may be interested in knowing about in the Kohli's dinner, whether some defaulter of the loan was present yesterday or not, or whether something else happened in some cricket match, or in the office also in the subject. But the subjects are of importance and everybody has a right to speak. We call it as freedom and restrictions. The restrictions do not apply to anybody, equivalent to our politicians also. So its subject is freedom and restrictions on speech and expressions in social media. This is the full title of the publication. Let me first share that this publication, I am referring to again the students, is authored by Miss Alankrita Singh, a student of National Law University, all the way from Jodhpur, Rajasthan. The society make a lot of efforts to find out the correct authors, and we are happy that the committee selected the students for this particular. One more student is coming later on. We had the privilege of the review of this publication done by our very senior past president, Mr. K.C. Narang. We have another publication which I am sure would be also very much useful, that is on the competition law. I referred to the student. Here we have the student called as Mr. Varun Thakkar, again a student from National University, Jodhpur. Both of them have been also assisted by one of our committee member, Jayant Thakur. This publication has been reviewed by Company Secretary Mr. Surendra Kastia, who is a Surendra Kastia and Associate Company Secretary. This is important in the time that we are living. The other part, which is again very important for the professional, that is the corporate social responsibility. This publication has been authored by none other than a very dear member of the society, member of the core group, CA Mr. Zubin Billimoria. He is present over here. The subject of insider trading for all papers, questions across, whether for the members or for the students, is of equal importance. So we have fourth monograph on prohibition of insider trading. This is authored by CA and Company Secretary Sanjeev Shah and Company Secretary Ruchi Shah. Both of them are present over here. We had the privilege of the same being reviewed by very eminent Advocate Nishchal Joshipura and Advocate Shreyas Bhushan, who both of them are traveling abroad and are not able to remain present over here. The fifth one, the talk of the town, what is happening at Cognizant or the other companies. The India's law on prevention of sexual harassment at workplace. We had the privilege of two eminent advocates, Advocate Preetha S. and Advocate Vikram Shroff. This entire publication, for getting this publication, we had a very tough time, but on just one con call to one of the very eminent lawyers of the country in the international law, Mr. Nishit Desai, with whom I shared the memory of traveling together for 1 year in bus number 122 from 1970 to 1973, from Flora Fountain to Nepean Sea Road. He just on one twinkle, he agreed to share the entire publication without any obligation on the part of the society. He not only shared, he also updated the same. Not only that, he also supported the society, as getting the reviewer in this publication was very tough for our committee. And he supported in ensuring that we get the correct reviewer to ensure the very high standards set up by the committee of the society. So with this is about the short of those publications. Let me say that it is not that something in the lighter way. These publications are written in a very simple and lucid language by all the authors, has been reviewed to make it up to the very high standards, and will be of very much use to all the members as well as students at large and public at large. In fact, I am told that the committee, the office bearers, has prized this for making the people to know more on the subject at a very special prize, which will be available from tomorrow at the society. So with this, I'll invite all the authors and reviewers present over here. I have some name. In case I miss somebody, please draw my attention. Mr. Zubin Billimoria, please come on the stage. Sanjeev Shah, Ruchi Shah, Surendra Kasetia, I think Vikram Thakur is also present. Varun Thakkar is also present. Please join. Sorry, not Varun Thakkar. Apna Vikram Shroff, the one who is from Nishit Desai for India's law on prevention and sexual harassment. So I'll request all of them to join over here. Preeti Ben, 1 second. Preeti Oza, the convener of the committee, has put up a lot of hard work. May I request Preeti Ben to join over here? The photographers are there. Please join.
you, audience, for being so patient. And one last thing, both the publications are available on sale today, and they are, as Kanubai rightly said, reasonably priced at 280 rupees per publication. Coming back to the reason for which we are all present here, we have two dynamic and young speakers who will take us through the various nuances of the 7 new ITR forms notified by the CBDT. Let me introduce Mr. Bhadresh Doshi. Bhadresh is a merit rank holder in all the 3 CA examinations. Foundation, he scored a 23rd rank, intermediate 33rd, and final 11th. He is a holder of the advanced diploma in international taxation, practicing as a proprietor by the name of Mr. Bhadresh Doshi and Associates in the last 15 years. His core area of practice are litigation matters up to IT-80 levels and consultation on income tax matters, including international tax. He is a member of the Taxation and Journal Committee of the BCAS, Vice Chairman of the Journal Committee of the Chamber of Tax Consultants. Recently authored a book on income declaration scheme 2016 for the BCAS, and was called to present it before the Finance Minister, Mr. Arun Jaitley, and the CBD Chairperson, Ms. Rani Singh Nair, on panel of authors for Taxman publication, co-author of budget publication of the BCAS. He's regularly giving presentations on direct tax matters at various forums, including Income Tax Department. Please join me in welcoming Mr. Bhadresh Doshi. The next speaker we have is Ms. Akshata Kapadia Kothari, who qualified as a CA in 2009. She was part of the Financial Service Corporate Tax team of the ENY Mumbai. She is currently working with Reliance Industries since over 4.5 years in the Direct Tax Center of Excellence team. She has prepared representations on direct tax issues and allied laws to be incorporated in the representations made by the ICAI, FICCI, CII before the tax and regulatory authorities. She is part of the Taxation Committee of the BCAS. Apart from that, she is a district-level table tennis player. Please join me in welcoming Akshata. And on behalf of all of us present here, I request Manish to present a memento to both the speakers as a mark of appreciation and regard. Akshata will start the first session. There are few seats here in the first row, if you can.
Everyone, filing of income tax return, the hanging sword above everyone's head in the latter half of the year. The topics that I'm going to cover are who is mandatorily required to file their return of income as per the Act, certain changes in the ITR forms, the mandatory quoting of the Aadhaar and linking it to the PAN, selection and applicability of the ITR forms, the procedure for filing the income tax return, and certain precautions which we should take while filing the return. Now, who is mandatorily required under the Income Tax Act to file their return of income? All companies, firms, including LLPs, irrespective of their level of income, whether there's a profit or a loss, or a no profit, no loss situation, they are still mandatorily required to file their return of income. Now, what about foreign companies? The Income Tax Act does not give a specific exemption to foreign companies to file their return in India. It would be absurd that all foreign companies would be required to file their return. So based on judicial precedents, a view can be taken that if a foreign company has a nexus in India and they earn certain income in India or from India, and which is chargeable to tax in India, then they are mandatorily required to file their return of income. In case of a resident who has a foreign asset or who has a signing authority to any bank account outside India, they would mandatorily be required to file their return. In case of individuals, HUFs, AOPs, BOI, artificial juridical persons, if their total income exceeds the maximum amount not chargeable to tax before considering certain deductions under Chapter 6A, Section 10, Section 10B, and 10BA, then they would mandatorily be required to file their return. To this list, the Finance Act 2016 from assessment year 17-18 onwards has also included long-term capital gains exempt under section 1038. So supposing an HUF has no other source of income but has only long-term capital gains exempt under section 1038 and that exceeds the maximum threshold of 2,50,000 which is applicable to assessment year 17-18, then that HUF would mandatorily be required to file their return of income. Let's take another example of an individual, say for assessment year 16-17 and 17-18, an individual has income from salary of 2,20,000 and long-term capital gains exempt under section 1038 amounting to 60,000. Now, is this individual required to file his return of income? For assessment year 16-17, his gross total income will be 2,20,000. Let's assume that there are no deductions under Chapter 6A and Section 10. So the total income is 2,20,000. It is below the threshold of 2,50,000, which was also the limit for AY 16-17. So he was not mandatorily required to file his return. However, for assessment year 17-18, with the amendment which has been introduced, I will have to consider the 60,000 rupees which is applicable to long-term capital gains which are exempt. So the income amounts to 2,80,000, which is above the threshold of 2,50,000. Therefore, for assessment year 17-18, this individual will mandatorily be required to file his return of income. Subsections 4A to 4F of section 139 gives a list of specific entities like charitable trusts, political parties, research associations, business trusts, who are mandatorily required to file their return of income. Now, what are the due dates by which I have to file my return of income? So if I'm an assessee to whom transfer pricing provisions apply, the due date is 30th November. Any other corporate assessee to whom transfer pricing provisions don't apply, it's 30th September. A person who's covered under audit, it's 30th September again. Also, if I'm a working partner of a firm to whom audit applies, the due date is 30th September. Now, let's take an example. Supposing this partnership firm, even transfer pricing provisions apply to this partnership firm, then the due date for the partnership firm will be 30th November. However, the due date for the working partner of such a firm is still 30th September. So this causes a little hardship to the working partner to file his return within this due date because it would be difficult for him to compute his remuneration as the allowances and disallowances would not have been finalized by the firm until the tax audit report has been actually filed. So ideally, in case of a working partner of a firm to whom transfer pricing provisions would also apply, it should have been 30th November, but however, the due date currently stands at 30th September. In case of all other assessees, the due date is 31st July, which is drawing pretty close. Now, what are the consequences if I do not file my return within these due dates which are applicable to me? In case of unpaid taxes, there would be penal interest of 1% per month or a part thereof if up to the date of which the taxes have been paid. So even if I don't file my return on time due to, say, some special circumstances or some emergency, it is advisable that at least the taxes have been paid within the due date so that there are no interest implications. Now, few people find it difficult while filing the return of income. I think there's some problem with the software, probably. Even if the taxes have been paid within the due date, but the return is filed after the due date, then there is an interest liability under section 234A which is being automatically computed. So I think in that case what we need to do is probably go for the manual option instead of the auto calculate the tax liability probably and then manually fill in the correct tax figures to avoid this 234A interest liability. There would be no carry forward of business loss or capital loss. However, losses which are on account of unabsorbed depreciation, even if the return is not filed within the due date, they would be allowed to be carried forward. Let's take an example. If an assessee has, say, a profit of 1 lakh from business and profession, and has depreciation of say 3 lakh rupees. Now he will have a loss of 2 lakhs. Now this loss is on account of unabsorbed depreciation. So even if this assessee does not file his return within the due date, this loss would be allowed to be carried forward since it is on account of unabsorbed depreciation. If I don't file my return on time and there is a refund situation, then I would lose out on interest under section 244A. The assessing officer can also levy a penalty of 5,000 rupees under section 271F if I do not file my return by the end of the relevant assessment year. So that will be 31st March 18. This section 271F has been substituted by a new section 234F, which is applicable from assessment year 18-19 onwards. So the penal implications are slightly getting stricter from the next assessment year. Certain amendments, defective return. So for assessment year 16-17, if I had a self-assessment tax due and interest on this self-assessment tax has not been paid along with the self-assessment tax amount, then my return was considered as a defective return. However, this amendment, this condition has been done away with by an amendment in the Finance Act 2017. So for assessment year 17-18, even if I have a self-assessment tax due which I have not paid by the due date of filing the return of income, my return will not be considered as a defective return. Belated return. The last date for filing the belated return has been reduced by 1 year. So up to AY 16-17, the last date for filing a belated return was 1 year from the end of the relevant assessment year. However, from assessment year 17-18 onwards, the time limit has been reduced to the last date of the relevant assessment year itself. So for assessment year 17-18, the last date will be 31st March 18. Coming to revised return. Up to assessment year 16-17, I could not revise my belated return. However, with an amendment in the Finance Act now, in case the assessee finds certain omissions or wrong statements in the belated return, the same can be revised from assessment year 17-18 onwards. Just to give a snapshot of all the dates that we just discussed, the last date to file a belated return from assessment year 17-18 onwards, the time limit has been reduced by a year, so it is by the end of the relevant assessment year. So for assessment year 17-18, it will be 31st March 18. The last date to file a revised return, up to assessment year 17-18, it is 1 year from the end of the relevant assessment year, so that will be 31st March 19. However, from assessment year 18-19 onwards, this time limit has been brought in line with that of the belated return, so it will be by the end of the relevant assessment year. So for assessment year 18-19 onwards also, the due date is 31st March 19. Can a belated return be revised? Yes, from assessment year 17-18 onwards. Applicability of late fees under section 234F, that is applicable from assessment year 18-19 onwards, which states that in case a return of income is not filed within the due date, so if an assessee's total income is less than 5 lakhs, then the penalty is 1,000 rupees. In case the assessee has a total income exceeding 5 lakhs and he does not file his return up to 31st December, then the amount is 5,000 rupees, and beyond 31st December it's 10,000. However, these late fee charges are applicable from assessment year 18-19 onwards. Mandatory quoting of the Aadhaar and linking it to the PAN. Having an Aadhaar card or not is no longer a question, and linking it to the PAN is no longer a choice. Though petitions have been filed with the Supreme Court, the issue is still under debate. The Finance Act 2017 has introduced a new section 139AA with effect from 1st July 2017, which states that every person who is eligible to obtain an Aadhaar number must quote his Aadhaar number, and in case he doesn't have an Aadhaar number, then the enrollment ID for obtaining the Aadhaar number in his return of income. Now let's first understand who is required to obtain an Aadhaar. Under the Aadhaar Act, any individual who is residing in India for a period of 182 days or more within a 12-month period is required to obtain an Aadhaar. So companies, firms, LLPs, etc., they are not required to obtain an Aadhaar. Only individuals are required. Certain representations were made because this would have caused hardships to non-residents and other individuals as well. The definition of non-resident under the Aadhaar Act differs from the definition of non-resident under the Income Tax Act. The CBDT has provided certain relaxations. So if I'm an individual who is considered as a non-resident under the Income Tax Act, or if I'm an individual who is not a citizen of India, or I am of 80 years and above, or if I'm residing in Jammu, Kashmir, Assam or Meghalaya, then I'm not required to quote my Aadhaar while filing the return. Now what happens if I don't quote my Aadhaar while filing the return? My PAN will be considered invalid. All penal implications under the Act for not having a valid PAN will apply to me. For example, the assessing officer can levy a penalty of rupees 10,000 under section 272B for not having a valid PAN. So I think we have no option, and it is better to quote the Aadhaar number while filing the return. Even the ITR 5 and the ITR 7 forms have been amended to capture the Aadhaar numbers of the partners, the beneficiaries, trustees, etc. Linking of the Aadhaar. When this requirement was first introduced, I think there was chaos all around because the linking was not simplified. There were a lot of errors happening. The procedure has now been fairly simple. If I go to the income tax e-filing portal, whether it's on the center or on the left-hand corner, I will find a link. That will take me to a simple page where I just need to put in my PAN, my Aadhaar number, my name as it is reflected exactly in the Aadhaar card, and the linking will happen successfully. If there is a minor mismatch in the names due to initials and it's expanded in one card and there's an initial mentioned in the other, then an OTP is sent on the registered mobile number, and on submitting that, the Aadhaar is linked successfully to the PAN. Linking via SMS facility is also available now on the numbers which are mentioned here. Coming to the tax return forms. Unlike the past practices, CBDT has notified the income tax returns way in advance. The notification came on 31st March itself, which gives ample time to the taxpayers to file their return within their due date. The number of forms have also been reduced. Previously there were 9 forms, now there are 7 forms. So the ITR 2, 2A and ITR 3 have been consolidated into one ITR 2. The ITR forms and their applicability. ITR 1, it is also known as the Sahaj. It is applicable only to individuals. It is the one-pager simplified form as promised in the budget 2017. It is applicable only to individuals who have income from salary or family pension, income from only one house property, and income from other sources excluding winning from lotteries or horse race. When I say one house property, income from one house property. So if I'm an assessee who has, say, a self-occupied property as well as a let-out property. Now my income from this self-occupied property would be nil, assuming I have no interest cost. And I have, say, 1 lakh income from my let-out property. Can this individual file the ITR 1? The answer is no. So though the income is only from the let-out property, the assessee actually has 2 properties. So ITR 2 will apply and not ITR 1. Even if I'm an individual who has a total income exceeding 50 lakhs, Rule 12 requires the details of my asset and liabilities. So ITR 1 will not apply and I'll have to file ITR 2. if I'm an individual who is earning dividend income exceeding 10 lakh rupees, which is to be taxed at a higher rate, or I have certain unexplained cash credit or investments, which is also taxed at a higher rate, then ITR 1 will not apply. Now, in case of income of another person, like a minor child or a spouse, which is clubbed with the income of the assessee, the return form can only be used if the income which is being clubbed falls in the sources of income which are mentioned in the ITR forms. So if there's an assessee who's a parent and who has income from, say, salary only, and he has a minor child who has income from capital gains. Now the income of this minor child is to be clubbed with that parent. So since the income of the minor child is from capital gains, this assessee cannot file ITR 1 and he will have to file ITR 2 because ITR 1 does not relate to capital gains. Recently, the CBDT issued a circular stating that they have noticed that in case of interest income of minors is being clubbed with the grandparents where the minor does not have his parents are deceased. So in such a situation, the CBDT has clarified that this was never the intent of the Act. So even if a minor doesn't have parents, his income cannot be clubbed with the grandparents, and the return of income will have to be filed in the name of the minor himself by the guardian. And even the tax credit certificate which is being issued cannot be issued in the name of the grandparents, it will have to be issued in the name of the minor. ITR 2, it applies to individuals and HUFs. It covers more than one house property if there's a loss from house property or other sources of income. If any income is being earned from a partnership firm by way of remuneration, commission, or in whatever name called, it will be covered by ITR 2. ITR 3 is one of the longest forms, covers everything possibly under the sun. It is for individuals and HUFs who earn income from business and profession. ITR 4, Sugam. It is applicable to individuals, HUFs and firms other than LLPs who are covered under the presumptive taxation. That is under 44 AD, 44 AE and 44 ADA of the Act. However, if these individuals, HUFs or firms, they voluntarily maintain their books of accounts and get them audited, then ITR 3 will apply in case of individuals and HUFs, and for firms, ITR 5 will apply. Now, if there's an individual who's covered under, say, presumptive taxation, but has income from capital gains, or has agricultural income which is exceeding 5,000, then to ITR 4 will not apply, and he will have to file ITR 3. ITR 5 covers firms, LLPs and AOPs who earn income from business and profession, house property, capital gains and other sources. ITR 6 is mainly for corporates, except charitable trusts, business trusts, who are mandatorily required to file their return under ITR 7. In the next two slides, I've just given the different sources of income against which ITR will apply. For example, if I'm a resident who has a foreign asset or has a bank account outside India and has signing authority for it, and no other source of income, then also I will not be able to file ITR 1, and ITR 2 or ITR 3 will apply. Even if I'm an individual who has taken some unilateral tax credit or some relief under the Act, then too I will not be able to file ITR 1, and ITR 2 or 3 will apply. Preparation and e-filing of the income tax return. There's not much change compared to last year. So ITR 1 and ITR 4, the pre-filling option is still available, which makes it simpler. The Excel utility and the Java utility facility is available for all the forms. And of course, various softwares are also there to further simplify the process. All ITR forms are mandatorily required to be filed electronically. A relaxation is only provided in case of ITR 1 and ITR 4, which can be filed in paper form, only to two categories. One is super senior citizens of 80 years and above, and secondly for an individual or an HUF who is earning income less than 5 lakh rupees and has no tax refund in the return of income. Only these two categories can file their return in paper form. There are three procedures. I can file without using a digital signature or through an e-return intermediary, or I can use a digital signature or e-verify. In the first two cases, I will need to generate the ITR 5, and once that is generated, I need to send it to CPC Bangalore within 120 days. It is a must that it reaches them within the time period, otherwise the return may be considered invalid. The income tax e-filing website now also has an option of tracking the status of this ITR acknowledgement. In case of e-filing using the digital signature or the electronic verification code, once I file the return and the acknowledgement is generated, there is no further action required. There are 6 ways in which I can e-verify the ITR forms. Through net banking. In this option, I'll have to log into my internet banking website. There'll be an e-verification option, and once I click on that, I'll be able to e-verify my return. Second is through the bank ATM. Once I log into the bank ATM, there'll be an e-verification code which will be generated, which I need to then submit on the e-filing website, and the process will be completed. Via Aadhaar, now it's anyways linked to the PAN, so it seems like the simplest option. So an OTP would be sent to the registered mobile number, and on submitting that, the process will be completed. I can also link it using my bank account number or my DMAT account number. So on the income tax website, I'll have to verify my bank account or DMAT account number, and an OTP is generated, and using that, I'll be able to then e-verify my return. The last option, which is e-verifying it through a registered mobile number or email address, is only applicable if the total income is less than 5 lakhs and there is no tax demand or refund situation. Only then I can go on the e-filing website, generate the EVC directly. Once it's received on my registered mobile number, I'll be able to complete the process. Precautions. Certain things that I need to keep in mind while preparing the return of income. One would be to prepare a checklist in order to verify whether tax audit is required or not. Is there a renewal of a digital signature which is required? To obtain the tax certificates and to match them with the 26AS in order to ensure that the TDS credit has been correctly mentioned in the return as well as the computation. If there are any past assessments based on which I need to change my position while filing the computation for the current year, then that should also be taken into consideration. Now with ICDS applicable from assessment year 17-18, though ICDS does not require me to maintain a separate set of books of accounts, I definitely need to maintain a separate record of all the adjustments which are made under ICDS, because this may have an impact in my future return. Let's take an example in case of construction contracts. AS7 and Ind AS does not require me to account for retention money unless it is actually received. However, as per ICDS 3, the revenue will have to be considered, which includes retention money. Therefore, I'm paying tax on it currently. Now, assuming that in future I do not receive this retention money, if I have not maintained a separate record of the adjustments that I've made under ICDS, it is possible that I may miss out claiming this as bad debts in the year in which I'm filing my return or preparing the computation. Therefore, I think it's a must that we need to maintain a separate record. Since we are in the so-called digital era now, and most of the communication from the income tax department happens online, it is required that the email address that we fill is a valid one, as well as the mobile number details also, which are included in the income tax return forms, so that any communication from the income tax department can be made smoothly. I'll now request Mr. Bhadresh Doshi to take us through the ITR forms that we just discussed. Thank you.
President Chetan Bhai, Treasurer Manish ji, my co-speaker Akshata, Pooja, Chairman of my committee Amit ji, all other dignitaries on the dais, off the dais, and my friends, good evening to all of you. Good evening to all of you. Friends, since last over a few days or rather few weeks, I'm feeling that I'm not existing in this world. The reason why is because I'm practicing exclusively on direct tax, and the people nowadays started asking queries on GST, for which I don't have any answers. I feel that to every citizen of this country, a constitutional right has been given to ask any chartered accountant at any time, at any place, any question on GST. And that chartered accountant is expected to answer that question. And if we cannot answer, it will be like it's like a punishable crime which that chartered accountant has done. Though you are a chartered accountant, but for the interviewer, you are a useless fellow. And the best part of this is, the question has been nominated as a question of the year, and that question is that whether really GST is going to come from 1st of July or not. So all of a sudden I started feeling that I have become outdated. But thanks to society and thanks to this crowd gathered here, I am trying to regain my confidence on the subject of direct tax and income tax return filing today. Please help me for that. Friends, before I begin to discuss about various income tax return forms and what all changes which have been made in this income tax return form, I would like to share a good news with all of you. This is an extract from the budget speech of our Honorable Finance Minister in this last year, 2017. And what he says, that I'm going to introduce a one-page simple form which will apply to all persons not having income more than 5 lakhs. This is fine. But then he further says that he has promised rather in a speech that those persons will be filing their income tax return for the first time, falling in this category. Which category? That one-page simple form, not having income of more than 5 lakhs, and that person who is filing return for the first time, that person will not be scrutinized at all by the income tax department unless the income tax department has a very specific information for high-value transactions which that person has entered. So this is really a good news. But the question is this really a good news for this assessment year 2017-18? Because we professionals always have the habit of interpreting what has been told to us or what has been written. Let me tell you first that there are no official notifications or circular from CBDT's side on this particular aspect, whether the first-time filer will be scrutinized or not. And when I tried to interpret what has been mentioned in the budget speech, I thought that it is a wrong message which has been given. This is because, number one, all the written forms which Akshata discussed with all of you, there is no such forms made specifically for that category of a taxpayer who doesn't have an income more than 5 lakhs. That ITR 1 Sahaj is meant for those individuals not having income more than 50 lakhs and not 5 lakhs. That is number one. And therefore, really whether that promise which has been given by Finance Minister, will it apply for assessment year 17-18 or not? And further, if you carefully look at the budget speech, the last sentence, he indicates the reason why he is trying to give that promise. He says that I want to encourage the people falling in that category of having income from 2.5 lakhs to 5 lakhs will be taxed mere just at 5% rate of tax. And now this 5% rate of tax is not applicable today, those returns which will be filing for assessment year 17-18, but this is applicable for those persons filing return for the next assessment year 2018-19. And therefore, whether this really a promise which has been given that will apply for assessment year 17-18 or that will apply for assessment year 18-19, nobody can predict. Only God can tell us. And therefore, no one should plan on the basis of this promise which has been given by Finance Minister, of course. Going to the topic, the most controversial and debated topic today is that each and every income tax return asks the taxpayer to submit the information of the cash deposits in all his bank account during this particular period, that is 9th of November 16 up to 30th of December 16. I don't know how come a cash could have been deposited on 9th of November because the bank started from 10th of November. But the income tax return form says that cash deposits starting from 9th of November 16. So if anyone has a privilege to deposit cash even on that day, should submit the, that particular information. This information is required to be given in the income tax return forms, all types of ITR, whether that person is filing ITR 1 or that person is filing ITR 3 having business, or if there is a company ITR 6 or even a charitable trust filing ITR 7, each and every taxpayer in all the returns filed should submit this particular information of cash deposit. This information of cash deposit is required to be given bank account wise, not in a consolidated form. So all the bank accounts, each bank account, what is the total amount of cash deposits during this period is required to be mentioned. And very important that this particular information is required to be given only if the aggregate amount of cash deposits during this period is equal to or more than 2 lakhs. So that person who had deposited a cash in his bank account during this period, but the aggregate amount of cash deposit in his bank account during that period is below 2 lakhs, this particular information is not applicable to that person and he need not worry about this particular disclosure to be given in this income tax return form. And this is how it looks like in the income tax return form. It is immediately below verification part. When we mention details of all our bank account, there is one more column which has been inserted, the last one, cash deposited during this period if aggregate cash deposit is equal to or more than 2 lakhs. Now, it's not very simple. Before I try to discuss the nuances of this, I want to raise two questions. Number one, this is a public notice which was inserted in all the leading newspapers during that particular period of demonetization, where it was being promised to all citizens of this country that you can safely deposit an amount up to 2,50,000 in your bank account. I am talking about old currency notes during that particular period, and it was being promised to everyone that this will not be investigated further. Just to highlight that portion, that there will be no harassment or no investigation. So this is the public notice which was being inserted in all the leading newspaper, and there the threshold given was 2,50,000. Now I don't know why the reason now the income tax return forms have been designed to capture the data of cash deposit of 2 lakhs or more than 2 lakhs, and why not more than 2,50,000 in line with this particular public notice. Further, there was an interview of the finance minister which got reported in leading newspapers during that particular period, and even a finance minister issued a statement in that interview, if you can read it, and it says that the revenue departments are not going to take notice of small depositors. In any case, deposit which are within the tax exempted limit, that is 2.5 lakhs, can be made into banking system without facing any inquiries. So even not only the Prime Minister, but even Finance Minister had also issued a supporting statement that any person can deposit safely 2,50,000 in his bank account without any worry or without any investigation or facing inquiries. So my first concern is that the income tax return forms design should be in tune, in line with this particular promises which were given to all citizens of this country, number one. The second concern which I want to raise here is a legal point, that there is a section 139, a subsection 6. And subsection 6 of section 139 mentions as to what all things which any particular income tax return can ask the taxpayer to furnish in his return. And this particular subsection 6 of section 139 provides that income tax return can ask you about the particulars of your bank account, particulars of your credit card, particulars of certain specified expenses crossing certain threshold limits. But I fail to understand as to whether the subsection 6 of section 139 really authorizes CBDT to come out with such kind of ITR forms wherein such kind of information about cash deposit during this particular period has been asked. According to me, to my mind, there has to be a corresponding amendment in section 139(6) first authorizing the CBDT to notify such kind of forms, because there if we read, it authorizes only asking particulars of bank account. It doesn't authorize asking particulars of transactions in the bank account. And this particular information is not just particular of bank account, but transactions of the bank account. So that's also really a legal question. But anyhow, we are faced with this particular situation, and we will have to report this information. Now it raises several questions. In my mind, I'm sure that you also must be having some or the other questions on this. I'll make an attempt to address all your questions which may arise on this particular information to be given about cash deposits. The first point here is that what we need to report is deposit of cash during that period. It is not very specific to deposit of specified banknotes which have been invalidated by RBI. So even any other currency notes deposited, 100 rupees notes, 50 rupees note, or even new currency notes of 2000 or 500, if any person has deposited cash in any form, not necessarily in only those forms of old currency notes of 500 or 1000, but deposits in any currency, any form of cash is required to be reported. I don't know the reason why. The second, the threshold given here is that if the aggregate amount of cash deposit is 2 lakhs or more than 2 lakhs. Now the issue which arises here, that whether the threshold limit is required to be seen in aggregate for all bank accounts which I am owning, or it is to be seen for an individual bank account. So to simplify this issue, I'll give you a simple example. I am owning 2 different bank accounts with 2 different banks. In one of the bank account, I deposited 1,50,000 during that period, and in my another bank account, I deposited 1 lakh during the same period. So if you take the total sum of deposits in both the bank accounts, it comes to 2,50,000. So do I need to report in my ITR that I have deposited 1,50,000 in first bank account and 1 lakh in second bank account, or whether this limit of 2 lakh should apply individually to each bank account? There is no clarity. Let me tell you, there is no clarity neither in the written form nor in the instructions supporting all the written forms. But what I understand from the way in which it has been given in the income tax return forms is that this limit of 2 lakhs will apply in aggregate to all the bank accounts. And therefore, in the example which I mentioned to you, that person is required to report that I have deposited 1,50,000 in my first bank account and 1 lakh in my second bank account, because the total deposit has crossed this particular threshold limit. I just want to highlight, this is not really an issue, but I just want to highlight that this threshold limit of 2 lakhs, we had some different threshold limits for the purpose of reporting of AIR, the new system which is called as SFT by the banks, and the banks must have reported only if that deposit in a savings bank account is 2.5 and in current account that deposit was 12.5. So this reporting by the taxpayer in the income tax return form will apply irrespective of whether that transaction was appearing in the AIR which was bank must have filed or not, because the threshold limits for reporting under AIR and the threshold limit for reporting your transaction on your own income tax return both differs. Further, the instructions supporting income tax return form mentions that this reporting is applicable not only to cash deposits in savings and current accounts, but this reporting will apply to deposits made in any other account, for example, any loan account. So person has deposited cash in a loan account, OD account, CC account, or a term loan account, or any account. Virtually this information is required to be given for cash deposited in any type of bank account. Now here the issue will arise, a practical issue which may arise is that how to report a 9-digit account number for the account which is neither a saving account nor a current account, because I believe that there are some of the banks must not have given that 9-digit account number to all types of loan accounts. So that issue, practical issue, difficulty may arise in such a case. But nevertheless, the person is required to deposit cash deposited in all types of bank account. Now the most important and the most issue which is arising here is how to tackle a situation where an account has been owned not by just one person, but there are more than one owner, joint owners of a particular bank account. Now here, assuming that there were cash deposits more than 2 lakh in that particular account, the issue is that we'll be reporting the cash deposited in that particular account. Whether the reporting has to be done by all the account holders of that particular account, or reporting has to be done only by the first person who is owning that account, that means the first owner, or reporting should be done by that person who has owned up that transaction, meaning thereby to say that it is out of my sources of income or my sources of wealth, and therefore I am owning up that this cash deposit is mine, and that person should report the cash deposit in his income tax return. That's an issue here. Once again, for even this issue, today unfortunately we don't have any clarity. But to avoid any other consequences which may arise, it is always better to report this cash deposits in ITR of all persons who are the joint owner of that bank account, and that to the total amount of cash deposited there. The other point which one should take care is that those persons who must have faced the inquiries in the form of cash transactions which were reported on the income tax portal, we were supposed to furnish a reply as to what is the source of the cash transactions which is appearing in my account. And therefore, one should ensure that whatever amount of cash deposited is reported in the income tax return, there should be proper supporting to justify as to what is the source from where I got this amount of cash in my hands, whether it represents my taxable income or not. If it represents my taxable income, whether I have offered that as an income, whether in past year or on this year, in which form. And if it doesn't represent my taxable income, are there any sufficient evidences to prove that it is not my income but some other sources? So a person must have taken care of all these points while reporting, while answering the cash transactions queries which were thrown on the income tax portal. So once again while reporting the same information in income tax return, one should once again tally as to whether everything is in order and everything is proper or not. We have received some queries in advance also as to, and one of the query which has been addressed to us is that what if the cash deposits is not crossing that particular threshold of 2 lakhs. So I have deposited only 50,000 in my bank account. Now I'm not supposed to report, but however, if you look at the format of that particular, if you look at the format of that particular income tax return form, there the reporting is required of all the bank accounts. Reporting is required for all the bank accounts. So I am required to report all my bank accounts. However, the last column, if it is applicable, I have to fill in the figure there. If it is not applicable, in that case, what to do? So the question is that if my cash deposits are there, but the cash deposits are not more than 2 lakhs, then do I need to put figure 0 there, or what should I do? That's the question. Because if I put figure 0 there, that means I have not deposited any cash. That indirectly it means. So here the difficulty is that the income tax return form has not been designed properly. There should be an option to say that it is not applicable to me. So that option of putting not applicable to me is not there neither in the form nor in the utilities which has been provided on the portal to mention that it is not applicable to me. So the options with which we are left is either to put that figure or to say 0, and we have to bear with the consequences of this unless they modify this particular return forms. The few important points which I want to once again highlight over here is, before I proceed to the next topic, that what is required to be reported over here is the figure of aggregate of cash deposits. Even the same bank account during the same period there were cash deposits as well as cash withdrawals. I am not required to set it off both. I have to independently report as to what is the total amount of cash deposits in that bank account, ignoring the cash withdrawals from the same bank account. The old currencies currency notes, if at all somebody has utilized the old currency notes without depositing first in the bank account for some permitted purposes. RBI had allowed the old currency notes to be utilized for some permitted purposes. There is no reporting of old currency notes utilized for some permitted purposes. No reporting is captured in the ITR form. Cash found and seized by any government authority. I was not allowed an opportunity to deposit this cash in my bank account. And I was found with the old currency notes by any government authority, and it has been confiscated from me, it has been seized from me. Even for that, I am not required to reflect this particular amount of old currency notes found and seized from me. Because this reporting will apply only if I have deposited this cash in my bank account, not otherwise. Even in those cases where RBI has allowed an extended window to residents, the extended window was available till 31st of March, and to non-resident extended window is still available till 30th of June. It is applicable in those cases where, owing to absence from India, the cash could not be deposited during that time period. So even those persons who are depositing this cash with the designated centers of RBI after this particular date of December 16, even this is not required to report it. So this reporting will go only if the cash is deposited in bank account during that particular time period. And friends, those who are handling companies, I would just like to point out that even the Companies Act requirement has been modified, and there has to be a disclosure as to what is the position of cash during this period from 8th of November to 30th of December. And this particular disclosure is very wide as compared to the disclosure contained in income tax return form, because there it talks about not only depositing in cash, but even the permitted payments is also to be reflected there, including the receipts, permitted receipts during that particular time period in specific banknotes as well as in other denominations. So those who are handling the companies while filing ITR 6 should be careful about reconciling the figures to be given in income tax return along with the figures which will be reported as per the Companies Act for this purpose. Let me move on to the other important topic for as far as the changes in the income tax return forms are concerned. We experienced an amendment, second amendment to the Income Tax Act by way of Taxation Law, Second Amendment Act 2016, whereby Section 115 BBE was amended and an option was given. It is like a sort of a permanent disclosure scheme that if you want to say that I have earned the income, but I don't know what is the source from where I earn the income, and you want to offer that income to tax without disclosing the sources of income, an opportunity has been given, and this is a permanent opportunity available under the Act. So one can make use of Section 115 BBE. Undisclosed income, rather income from unexplained sources, can be offered to tax while filing the income tax return. But here the amendment was that earlier it used to be taxed at 30%. Now the rate of tax has been increased from 30% to 60%, number one. Second, a special surcharge of 25% has been made applicable to this particular tax to be calculated under Section 115 BBE, and this surcharge of 25% will apply irrespective of the amount of total income, whether it crosses 1 crore or not. And therefore, effectively, if I add 3%, it says over this, effective rate of tax will come to 77.25%. So in order to incorporate this particular changes in the income tax return forms, all respective income tax return forms have been modified except for ITR 1 and ITR 4, because ITR 1 and 4 will not apply to those persons who are declaring income under this particular heads. So except barring those two ITRs, all other ITR forms have been modified. There's a change in Schedule OS, that is income from other sources, and if you want to declare your income voluntarily under this particular heads, an opportunity has been given. You select the particular section, and under that particular section, if you want to declare your income, you can do that. So this will help in those cases where the cash old currency notes were deposited during this demonetization period, and the total amount of deposit was disproportionate to the sources of income which that person is regularly earning. And therefore, he is not able to justify the source from where he got this much amount of cash. He was given an opportunity to declare this under old IDS declaration scheme, that is IDS 1. A second time opportunity was given in the form of PMGKY, that is Prime Minister Garib Kalyan Yojana, for second time. If you have missed both these opportunities and still you want to come out of the harsh consequences which may arise. That person can mention that figure of cash deposited by him as his income under this heads, can pay the tax at 77.25% on that particular amount and get out of all other consequences which may otherwise arise. So this income is to be disclosed separately in the income tax return form so that the corresponding higher amount of tax can be calculated whenever the income tax department come to know as to what is the amount which that person has offered voluntarily under this particular head. A corresponding change has been made even to Schedule SI, that is income chargeable at special rate, to incorporate 60% higher rate of tax on this, and further that main computation of tax liability has also been suitably modified to levy special surcharge of 25% on this. The next change which I want to discuss about is the schedule of assets and liabilities. Friends, this is not something which is new. This schedule of assets and liability was introduced in last year. In fact, it was there even before that. But an exhaustive schedule was incorporated in last year, where a person was required to furnish details of all his assets and liabilities at the end of year, other than those which he must have reported in his business balance sheet in Part A balance sheet. So if you have both business as well as non-business assets, then business assets and liabilities are required to be reported in that balance sheet schedule, that is Part A BS, and all other assets and liabilities other than business is required to be reported in this Schedule AL. This is applicable only where the total income is more than 50 lakhs. So those persons who are not having income more than 50 lakhs are not required to worry about this. So this has continued even in this assessment year 17-18, but there are few changes which I want to highlight. Number one, it has been removed from ITR 1. As in any case, it is not applicable to that person who has an income of more than 50 lakhs. And this reporting requirement was applicable only to those cases where the income was more than 50 lakhs. And therefore, it has been removed from ITR 1. And further advantage is that ITR 1 has been simplified. It has become one-page form. Then in last year, depending upon ITR, the format of that schedule was differing. Now we don't have such difference in the format of the Schedule AL. Irrespective of the ITR form, the same Schedule AL is applicable. Now, in new forms, there is a change in the format of reporting of assets and liabilities. We have been given more detailed format. There are two main changes. Number one, I'll just put that schedule in front of you. This is the schedule, how it looks. Schedule AL, assets and liabilities. The first change, this is the old schedule which was there in ITRs for the last year. And as compared to this, now we have this revised Schedule AL. So the first change is, in details of immovable properties, even in last ITRs, we were required to report, we were required to give the details of value, in terms of values of immovable properties owned by the taxpayer. Now the change is not only a value, but that person is required to give the details of description of that immovable property and the address where that immovable property has been located. So friends, what I understand is that this is the backdoor entry of that property registry which we are talking about, people were talking about immediately after demonetization. Fortunately, this is applicable only to those persons who are earning income more than 50 lakhs and not applicable to each and every taxpayer. So now a person is required to give all the details of immovable properties owned by him. This is the first change. The second change, interestingly, is that Part C, which is appearing in the bottom, this was not there in last year's income tax return forms, and that changes that now person is required to report the amount of interest held by him in the assets of, number one, a partnership firm, and second is association of person as a partner or member in that firm or AOP. So earlier, the person was not required to report this figure, but now, because of this change, I need to report this. So if I am a partner in any partnership firm, what I am supposed to do is that I will have to value all the assets and liabilities of that partnership firm and corresponding share, my share in all the assets and liabilities, that is the net amount of assets minus liabilities, my share in that net assets of that partnership firm, I will have to capture over here and I will have to report over here in my schedule assets and liabilities. Friends, please note that if any person is a partner in a firm, ITR 3 already incorporates Schedule IF Schedule IF is a schedule wherein I need to mention the details of the firm in which I am a partner. That is the name of that partnership firm, its permanent account number, whether it is liable for tax audit, whether transfer pricing audit is applicable or not, what is my profit sharing ratio, and what is my capital balance in that partnership firm. It is over and above this, I will have to value my interest in the net assets of the partnership firm or in AOP where I am a member, which I am supposed to report over here. And the important point here is that by any chance, if you are a partner in a firm and you are not reporting this, perhaps there will be a mismatch which can be determined at the central level. That is because a partnership firm's return will mention as to who all persons are partners of this particular partnership firm in this particular previous year, along with the PAN number. And the corresponding partner having the same PAN number is not reporting as to what is the value of his interest in that partnership firm and leaving this particular part as blank. So therefore, there can be an automatic mismatch and queries can be thrown to those persons who are not reporting this particular figure over here. Friends, it's very simple to say here that I am required to report the value of interest which I am holding in my partnership firm. But the important question here is that how do I value that amount? Only clarity there appearing in, there is no further clarity, no guidance available anywhere in the instruction, only clarity available, and that is written over here itself. It says that assesses investment in the firm or AOP on cost basis. So it has to be on a cost basis. Cost to whom? Whether to that partner or to the partnership firm. Of course, it should be to cost to that partnership firm. So all the assets and liabilities owned by that partnership firm will have to be determined on cost basis, and the corresponding share is required to be included over here. So this is about Schedule AL. The next one is Schedule on ICDS. So now that ICDS is back once again, it was notified for last year and it was being extended. The applicability of ICDS was extended by 1 more year, and therefore now finally it is in effect in spite of number of representations made, including our society. That proposal has not been accepted and now it has become effective. So there are, friends, 10 standards which have been notified under section 145(2). This is applicable for computation of business income or income from other sources, both. This will apply only to those assessors who are following mercantile system of accounting. However, this will not apply to individual or HUF who is not required to get their books of accounts audited under section 44AB. And therefore, wherever this ICDS is applicable, let's try to understand as to how the ITR form is required to be prepared in order to incorporate this applicability of ICDS. So this will apply, I'm sorry, there is a mistake in my slide. It should be ITR 3 and not ITR 4. ITR 4 is meant for those persons who are offering their income on presumptive basis, and therefore it is only ITR 3, 5 and 6. These 3 ITR incorporates a specific disclosure as far as effect of ICDS is concerned. So what is that? Let's try to understand. The first reporting is there in part A, other information, and item number 3 over there. And here, that person is required to report the total figure of effect on profit because of some or the other deviation as compared to what are the provisions which are contained in any of these 10 different standards. So there's only one simple reporting of one figure over there. Friends, before I proceed further, let me tell you that those persons who are filing their income tax return form that in ITR 3, that means individual HUF, having business income, this reporting will apply to them only if they are subject to a tax audit under section 44AB, because they are individual and HUF, and therefore if they are not subject to tax audit, though they are engaged into some business or profession, but if they are not subject to tax audit under section 44AB, they have nothing to do with this particular reporting of ICDS, is because ICDS itself is not applicable to them. Coming to other persons, those persons who are filing ITR 5 or 6, so firm filing ITR 5 or a company filing ITR 6, now to this assesses, ICDS is compulsorily applicable to them. It is irrespective of whether the tax audit under the provisions of section 44AB is applicable to them or not, because that relaxation is applicable only to individual or HUF and not to any other assesses. And therefore, whether they are subject to tax audit under 44AB or not, the ICDS is applicable. But however, reporting over here in ITR 5 and 6 is an optional reporting. It's because this Part A OI is an optional to them who are not falling under the provisions of section 44AB. If you have read carefully, that Part A OI itself mentions in bracket that this is an optional reporting for those persons who are not subject to tax audit under section 44AB. And therefore, for ITR 5 and 6, those persons who are not falling into tax audit under 44AB, ICDS will apply. They will have to compute the income by applying ICDS. However, reporting of this figure in income tax return is an optional to them. Now this figure to be reported over here is an auto-populated figure. You can't just put figure over there because there is a corresponding schedule, and that schedule is named as, titled as schedule ICDS. So you'll have to fill in that schedule first, and from that schedule the automatically figure will be captured over here in Part A other information. So how that schedule goes. In that schedule, it's a simple schedule. There's a tabular form wherein for each 10 ICDS I have to mention one figure. So that schedule captures this figure ICDS wise, and a total figure of this schedule goes over there in Part A other information. But few points which one should take care about reporting of ICDS impact in this schedule of ICDS is, as I have mentioned, there should not be any overlapping. For each ICDS you have to mention the corresponding figure as to what is the impact on the net profit as per P&L account which that person must have reported in the profit and loss account schedule of ITR. So if some item is appearing in my profit and loss account and the treatment of that item which is appearing in my profit and loss account is not in tune with the requirement as per ICDS, and therefore it has an impact whether positive or negative. So that difference is required to be reported for each ICDS in that schedule ICDS. If my profit and loss account is in line with the ICDS provision, then there is no further reporting which is required to be made over here. So reporting is required only if there is a deviation. No deviation, no reporting. The reporting is required to be done for the total amount of impact on my PGBP head of income, that is my profits and gains of business, as well as the impact on income from other sources. Because this ICDS is applicable not only for my business income, but ICDS will apply even for computation of my income from other sources, and therefore this schedule ICDS should capture the total amount of deviation from ICDS impacting both business income as well as income from other sources. However, this impact on income from other sources should be captured over here only if that income has been credited to my profit and loss account, because this schedule is applicable to compute what is the deviation as compared to my profit which is appearing in profit and loss account. So in those cases, for example, individuals or HUF filing income tax return in form ITR 3 to whom tax audit is applicable, I am assuming that, and only in that case ICDS will apply. May be possible that they are not crediting their other sources income in their profit and loss account of business which they have prepared. So in such a case, the schedule ICDS should cover up only impact on business income and not an impact on income from other sources. So that is the point which one should take care. And this impact is required to be reported whether it has a positive impact or it has a negative impact. It may be a case where a person was not taking some deduction or allowance which was otherwise available, and because of ICDS that deduction will automatically apply and that person should claim that deduction on account of effect of ICDS. So may be possible that ICDS may have a negative impact. So it is irrespective of whether it has a positive impact or a negative impact, this is required to be reported. Now, I was wondering as to why this schedule ICDS is not automatically captured even in schedule BP, because it will always by default it will have an impact over my computation of income. The very reason of including this schedule ICDS in ITR form is to understand as to how this will have an impact on computation of taxable income of that particular person to whom ICDS is applicable. But however, when you look at schedule BP is a schedule to compute business income. Nowhere in this schedule BP an automatic adjustment is done capturing that figure from schedule ICDS. And the very simple reason which I found over here is that since that schedule ICDS will capture the impact on both the heads, that is business income and income from other sources, it doesn't make any sense in capturing that figure automatically for computation of business income. So what we are supposed to do is that total cumulative impact of schedule ICDS will have to bifurcate this manually as to what is that figure which will impact business income and what is that figure which will impact income from other sources. And only that figure which impacts my business income, I need to put that amount manually over here in schedule BP. If that figure is a positive figure, that is required to be added at item number 23 over here as to any other item of additions under section 28 to 44DA. So it is so vast enough that it will cover up this particular adjustment. It's a residual adjustment. And if it has a negative impact, if I am eligible for an additional deduction on account of ICDS, which will be very rare, so that is to be reported at item number 32 over here as to any other amount allowable as deduction. The next point is about taxable dividend. Friends, I wanted to cover up these three topics in more detail. Now, rest all topics, looking at the time constraint, I'll just try to rush through, and wherever important points are there, I'll try to address them. So, taxable dividend, now we have a new provision which has been introduced in the form of section 115 BBDA, and any person who has earned an annual dividend of more than 10 lakhs in a year, individual HUF or firm, that excess amount of dividend over and above 10 lakhs is taxable at 10% rate of tax under this provision. So there is a corresponding change which has been incorporated once again in other sources income schedule, that is schedule OAS. So first of all, I need to report. So for example, if I have received a dividend of 15 lakhs in this particular year, assessment year 17-18, first I'll report that 15 lakhs of, out of 15 lakhs, 10 lakhs is exempt. So that is not required to be included in my computation of income. That will go in my exempt income schedule. And the excess amount of 5 lakhs, I need to first include this in my dividend income, which is there appearing in income from other sources schedule. And then further, I'll have to show this dividend amount of 5 lakhs, which is taxable under this provision, as a specific item which is taxable at 10% rate of tax. Then only it will capture this concessional rate of tax of 10%. Otherwise, it will get taxed automatically at the normal rate which is applicable to that person. So one should take care of that particular reporting at two different places to overcome that calculation of excess amount of tax. The next one is 115 BBF. Is once again a new provision introduced that residents' royalty income, to make them par on with non-residents, is also taxable at 10% rate of tax, of course subject to several conditions. I am not trying to analyze those provisions. The idea is to understand the changes in the income tax return forms. So if any person has earned this particular income of royalty which is eligible to pay tax at 10% rate of tax under this provision, is required to be reported separately in income tax return form, once again in other sources income schedule, as well as schedule SI, that is income taxable at special rate. And moreover, even in MAT schedule, in case of companies, the corresponding adjustments are required to be done, because this is not covered under MAT provision. Otherwise, this will get taxed at 18.5%, and it doesn't make any sense in extending this concession. The next is about presumptive taxation. The 44AD, the most important change over here is that in case of digital turnover, I am calling it as a digital turnover, the Act uses the words that that part of turnover or gross receipt which is received in these three modes: account pay check, account pay bank draft, or use of electronic clearing system through a bank account. This particular amount of turnover, the rate of presumptive income is applicable there is 6%, and excluding this, the balance part of turnover, the rate of 8% will apply. So this is a change which has been made effective from assessment year 17-18, though included in the last Finance Act. But since it has been made effective from assessment year 17-18, there is a corresponding change which has been incorporated in ITR 5 in order to bifurcate this turnover as to what is that amount of turnover which you have received through these three modes and the balance amount of turnover, and therefore the different types of income can be calculated on that 6% and on the balance 8%. So that change has been incorporated in this ITR 4. Here a few points very quickly I want to highlight over here is, for my young friends, I just want to throw food for thought over here is that it uses the word, the mode of receipt should be use of an electronic clearing system through a bank account. So I believe NEFTs, RTGS, credit cards, debit cards will be considered as eligible over here. But the real question here is that whether if a person has received these payments through modes like e-wallets, whether it will be considered as an eligible over here to compute the income at the rate of 6% or not, because I am not able to understand that whether really this can be called the payments through like apps like Paytm, etc. Can it be called it's an electronic clearing system through a bank account? Because there is no corresponding bank account over here, and therefore that person will be eligible to compute income at a lesser rate of 6% or not. Further, it may be possible that the person is otherwise eligible to offer this presumptive scheme of taxation under 44 AD. But the problem here is that the turnover has also been made by that person in this year, but he is not able to realize from his customer. So what if the 6% and 8% bifurcation is fine, but 6% concession will apply only if I have received through this any of these modes, and that too before the due date specified under section 139. So whatever is the due date applicable to me for filing my income tax return, it is must that I should have received by these modes only by the due date. So in a case where that person is not able to realize from his customer before that due date, what is the rate of presumptive income which will apply? According to me, the rate of presumptive income applicable there is 8% and not 6%, because there is a very specific condition over here. And therefore, those persons for whom the the collection from the customer itself has become doubtful, it may be possible that it will become a bad debt for that person, but for that person he has to offer the income, he has to compute the income basically always at 8%, and he is not eligible to compute his income at the rate of reduced rate of 6%. And the idea over here, which I understand, is that the Prime Minister and Finance Minister of this country would like to make this country as cashless and not moneyless. So if you're left with no money, you have to pay the tax by computing your income at 8%. It is only cashless turnover you are making. You need to, you can enjoy this particular tax concession. One more point over here, that it may be possible that you can't wait always till last date to file your return. And therefore, may be possible that immediately in the month of June, you are filing your return in the form of ITR 4 and computing income at 6% and 8%. Over here, if some more transactions have been realized after filing of return, but before the due date, once again that return can be revised by lowering the income for that part of turnover from 8% to 6%, because the date applicable is the due date and not the actual date of filing of return. So that point one should take care of it. The next is presumptive schemes for professionals, which has been introduced for the first time in the provisions of section 44 ADA. The corresponding changes have been made, of course, in ITR 4 to include this presumptive scheme for professionals. Even corresponding changes have been made in ITR 3 as well as ITR 5. It may be possible that for some or the other reason ITR 4 is not applicable to me. For example, I have a dividend income which is taxable at 10%, so ITR 4 will not apply to me. So in such a case, I need to submit my return in ITR 3 and 5. So even corresponding changes have also been incorporated over there. There are several new deductions. I will not discuss each one of these in detail, but the corresponding changes have been incorporated so that you can claim these new deductions which are available for the first time from assessment year 2017-18. To name few, the first one is deduction under 80EE in respect of interest on housing loans. So over and above your income from house property deduction, you can come here and you can claim a deduction of not more than 50,000 subject to several conditions. There is an exemption from long-term capital gain in the provisions of 54EE. Tax holiday has been introduced for profits for real estate industry in the form of section 80IBA. Deduction tax holiday once again to startup units under the provisions of 80IAC. So all these new deductions which are available have been incorporated in the corresponding income tax return forms. Coming to ITR 6, very important. Those domestic companies who want to opt for lower taxation at 25% rate of tax under section 115BA, this is a new provision once again which has been introduced, that subject to certain condition, if you are ready to forego some deductions and benefits which are available to you otherwise, you can compute your income at a higher level, but the rate of tax applicable on that higher amount of income is the 25% rate of tax, a concession rate of tax. So if you need to opt for that. So if you want to opt for that, there is a question which has been introduced in ITR 6. There you have to put a tick mark. Only in that case, this scheme will apply to you, not otherwise. Second, those domestic companies whose turnover was not exceeding 5 crores in previous year 2014-15, to them automatically the rate of tax is 29%. So 1% tax rate concession has been given to them. They are not required to forego any deductions as like in those cases of 115BA. So it is very important that you answer that question as yes wherever applicable. Only in that case you can compute your tax at lower rate of 29%. Otherwise this benefit will not be given to you. There are a few other specific provisions like International Financial Services Center, etc., which I am trying to skip. ITR 7, for those entities claiming exemptions like charitable institutions, religious institutions, etc., for them 3 new schedules have been incorporated. They have to now mention the details of their income from property held under trust. Number 1 in specific schedule, that is AI. Second, if at all they want to claim any application of this income for their object which is on revenue account, there is a specific schedule ER. And the application on capital field, there is once again a specific schedule EC which has been incorporated. So you have to give all the details in this detailed format in ITR 7. And one of the points which I want to highlight over here is, I don't know whether Ministry of Finance has realized this point or not, but in this schedule AI, the aggregate amount of income to be reported by this charitable organizations or religious organizations who are registered under 12A, and one of the items which they have included over there is agricultural income. Now this agricultural income is otherwise exempt under section 10(1) even in their hands. They are not entitled to claim any other exemption, but agricultural income's exemption is applicable to them. So I'm not able to understand as to why they are asking them to include their agricultural income in computation of income without allowing the exemption. I'm not able to understand. A few more provisions which one should take care as to rebate. There is no change in the ITR form, but I'm just trying to highlight as to these are the few amendments which are applicable, which one should take care of. As to rebate of 87A 5,000, it is now 5,000 which will apply, and corresponding increase in the rate of surcharge that will also apply. Period of holding for unlisted securities has been reduced. There is some relaxation which has been given in claiming deduction under section 32AC for the last date by which that those machineries, etc., which are required to be installed. And the last point to conclude is to what one should ensure while submitting his income tax return. Now, in my view, there are 3 points which one should ensure. The return which has been filed should be the correct one. Otherwise, there are harsh consequences under the Act which may follow, like prosecution, penalty, etc. The second one, it should be complete. Otherwise, this can be regarded as a defective return, or some or the other benefits which are available, these benefits will not be given to that person. To give you a simple example, if I want to claim deduction under ATG, the corresponding details of the institute to which these donations have been given is required to be reported. And the last one is that it should be consistent. So if there is no consistency over here, and consistency is required to be maintained throughout the income tax return forms, consistency with various other audit reports. We have tax audit report, we have MAT report under 115 JB, we have other returns like VAT, service tax, etc. So whatever figure we capture over here should be consistent with all other such reports and returns. Friends, with this I'll conclude my presentation, and with the permission of President Sir, if there are any queries on this, I would be happy to entertain all those queries. Thank you, friends, for your patience here.
Thank you, Bhadresh. Thank you, Akshata. There was just 2 minutes will take to conclude, not more than that. So all ITR form utilities are now available on the site. So there was some WhatsApp going around that ITR 6 is still not available, but it's not the fact. All ITR utilities are available, and I will request now Pooja to do the honors. So the slide is there of Q&A, but since we are out of time, we are not having any. So this slide is now a little bit misleading.
Before coming to the pleasant task of giving the vote of thanks, I would like to make a few announcements. We have the International Tax and Finance Conference coming up. That's being held at Conrad Hotel, Pune from 10th August to 13th of August. We also have a GST clinic running at the BCA office, open for members. That goes on every Saturday. Plus, we have a 2-day GST seminar on 24th and 25th June at Ghatkopar. Now coming to the pleasant task of vote of thanks. Friends, you will all agree, today's lecture meeting was one practical guide to filing of income tax returns. As we all return from here and head to our offices, we're all little more wiser than what we were at the beginning of this lecture. I, on behalf of BCA Society and on behalf of all of you, would like to thank both Bhadresh and Akshata for sparing invaluable time and addressing us. Thank you, Bhadresh. Thank you, Akshata.